There is a completely legal way for a business owner to knock up to $72,000 off their taxable income in a single year. Not a gray area, not a loophole that's about to close. It's written directly into the tax code. And here's the crazy part. Most business owners have never even heard the full version of it. Their accountant files the return. Nobody brings it up. And the deduction is just quietly expiring every year before December. I'm a certified public accountant, and setting this up is one of the most profitable moves we make for business owner clients. So in the next few minutes, I'll show you exactly how it works in plain English. You'll see the real numbers for 2026, who qualifies, and the version of this that can shelter over $140,000 in one household. And stay until the end because there is a deadline on this. If you miss it, and this year's version of the deduction is gone forever. So let's start with why your version of the 401k is better than everyone else's. So you already know what a 401k is. You had one if you ever had a job. And as an employee, you could only ever put in so much because you only wore one hat. And here's what changes when you own the business. The IRS sees you as two people, the employee who works in the business and the employer who owns it. A solo 401k lets you contribute wearing both hats. As the employee, you can put up to $24,500 in 2026. Then, as the employer, your business can add on top of that up to 25% of your compensation. So stack both hats and the total can reach $72,000 for the year. And if you're over 50 years age, a catch-up contribution takes you to $80,000. So compare that to an IRA where the ceiling is around $7,500. Same tax code, 10 times the shelter. That's the ownership advantage. And most owners are leaving almost all of it on the table. All right, so let's make this real with real numbers because the deduction is where this gets exciting. So every dollar you put into the traditional side of a solo 401k comes off your taxable income. So say you're a business owner with a strong profit, and between federal and state, you lose around 35 cents of every marginal dollar of tax. You contribute $40,000 to your solo 401k. That one move just cut your tax bill by roughly $14,000 this year. In cash, you do not need to send to the IRS. All right. And here's the part people miss. That money is not spent. It's not gone. It's yours, sitting in your own investment account, growing for you instead of being mailed to the government. See, most deductions make you spend $1 to save 35 cents. This one lets you keep the dollar and save 35 cents. And then the dollar goes to work. Run that same $40,000 a year for the next 15 years at an ordinary market return. And you're not looking at $600,000 in contribution. You're looking at well over $1 million built almost entirely out of money that would have gone to taxes and spending. That's the real play here. It's not a deduction. It's a wealth machine wearing a deduction as a disguise. This is why this is one of the first strategies we look at for every profitable business owner client of ours. All right, so now, who gets to use this? The rules are simpler than people think. You qualify if you have self-employment income at any amount and no full-time employees. So think like freelancers, consultants, contractors, agency owners, real estate agents, online business owners, side hustlers with a day job. All of it counts. And the last one deserves additional explanation because almost nobody explains it. And hear me out. If you have a W-2 job and a side business, you can have your job's 401k and your own solo 401k at the same time. There is one rule though. Your employee contribution, the $24,500, is one shared bucket across all of your plans combined. You cannot double it. But the employer side is separate for each plan. So even if you max out your employee bucket at your day job, your side business can still make its own employer contribution into your solo 401k on top of that. That's extra sheltered money most side hustlers have no idea they're allowed to touch. There is one beautiful exception to the no employee rule though, your spouse. If you're married and your spouse works legitimately in your business, they can have their own solo 401k inside of the same plan with their own separate limits. So run the math on that. Two owners, both hats each, and one household can shelter up to $144,000 in a single year. $160,000 if you're over 50. This is the single most underused retirement move I see in family businesses, and it's sitting right there in the code. But one honest caveat, the spouse has to actually work in the business and be paid reasonably for the work. All right, paper rolls do not survive an audit. You have to do it properly and make it bulletproof. So here's where this gets strategic and where most online videos stop short of explaining. So if you run your business as an S corporation, your solo 401k and your salary are connected. Your employee contribution can only come out of your W-2 wages you actually pay yourself. And the employer contribution is calculated as 25% of that same salary. So if you set your salary super low to dodge payroll tax, you just quietly strangled your own retirement deduction. Pay yourself $40,000, for example, and your employer side caps at $10,000. Let's say you pay yourself $80,000 and the employer side can reach $20,000 plus the full employee deferral on top of that. This is exactly why salary, entity, and retirement have to be designed together as one system. Change one dial and the other two move along with it. That's the difference between a strategy and a bunch of disconnected tips. And it's precisely the design work we do for our clients. So two more things you need to know. First, the solo 401k comes in two flavors. We have the traditional where you take the deduction now and pay taxes on it later in retirement. Then we have Roth where you skip the deduction now and every dollar of growth comes out completely tax-free later. So high tax bracket now, you lean towards traditional. If you're expecting a high tax bracket later, Roth gets very attractive. Most of our clients end up using a mix, and the right split depends on your retirement numbers. Here's the simple way to think about it. The traditional side is a bet that your tax rate today is higher than it will be in retirement. For a business owner in peak earning years, that's often a very good bet. The Roth side is insurance against the opposite. So tax rates in this country are historically low right now, and nobody can promise you that they stay there. So the sophisticated move isn't picking a side, splitting your contribution so part of your retirement is deducted at today's high bracket and part of it comes out completely untouchable later, no matter what Congress does. That split is a design decision and it's different for every client, which is exactly the point. This account has settings, and the settings are where the money is. So now, the mistakes. Mistake number one is assuming your regular financial advisor set this up. Most never mention it because a solo 401k often means money they don't manage. Mistake number two is confusing this with a SEP IRA. A SEP only gets the employer side. To hit the same $72,000 with a SEP, you'd need almost $300,000 in compensation. The solo 401k gets there far faster because of the employee hat. Mistake number three is hiring a full-time employee and not realizing the solo plan rule changes completely. The moment you have eligible employees, this becomes a different conversation. Mistake number 4, the big one, waiting until tax season. By the time you're filing in April, the cleanest version of this year's opportunity has already passed. So here's the timing rule that costs people the most. So to capture the full version of this for 2026, your plan needs to be set up before December 31st. Some pieces can be funded after year end, all the way up to your tax filing deadline, but the plan itself and your employee deferral are a before year end game. Every year, business owners discover this strategy in March. They love it, and then they find out they're locked out of the biggest piece until next year. So please do not be that March person. Be the December person. So here's the bottom line. If you're a business owner with a real profit and no solo 401k, you are almost certainly overpaying the IRS by 5 figures and funding everyone else's retirement except your own. The fix is one properly designed plan. So we're talking salary, entity, and contributions working together. That's exactly what we build at HK Financial Advisory. We'll run your numbers, design the right structure for you, and get it in place before the deadline. So book a strategy session with my team. The link is right below this video. Do it now while there is still time on the calendar to actually use this year's deduction. Until then, I'll see you on the next video.